Welcome, I'm John Mark Gray, and today we're delving into the intricate world of long-term investing. Before we navigate the currents of the financial markets, I invite you to explore my latest books, a treasure trove of insights designed to profoundly enrich your understanding of our complex global landscape. Now, let's embark on our discussion of financial markets, a realm where fortunes are forged and lessons learned. At the heart of the financial world lies an age-old, fiercely contested debate. Is it better to trade the volatile daily currents or patiently invest for the long haul? This isn't merely a discussion, it's a clash of philosophies, with devoted adherents on both sides so convinced of their righteousness, they'd carry their convictions to their very graves. My father, a staunch advocate and practitioner of long-term investing, holds rather unyielding views on this subject, and, all things considered, he's been remarkably successful. However, his journey began with distinct advantages that elude many of today's younger market participants. He entered the financial arena long before its borders dissolved, before capital flowed across continents like an unstoppable river, and before a tidal wave of global money inflated asset valuations across the board. Crucially, he began investing long before the era of unprecedented monetary expansion, before central banks became gargantuan purchasers of assets, artificially juicing the market. This unprecedented intervention, coupled with runaway inflation, drastically altered the investing landscape. Yet, even with these tailwinds, my father still possessed the keen insight to identify and back enough fundamentally sound businesses to make his long-term strategy a resounding success. Today, he proudly oversees an impressive $8 million investment portfolio. What many don't realize, however, is that until quite recently, this portfolio hovered at a far more modest $2 to $2.5 million. The dramatic surge, the very bedrock of his current wealth, can largely be attributed to a single, long-term holding, Eli Lilly. This pharmaceutical giant didn't just grow, it blasted off like a veritable rocket ship, fueled by its groundbreaking weight loss and diabetes drugs, true game-changers that reshaped the entire pharmaceutical landscape. Growing up in Indianapolis, Indiana, the very birthplace of Eli Lilly and Company, my father acquired this stock decades ago, holding it steadfastly through thick and thin. For the longest time, let's be candid, it was a rather sleepy stock, a quiet cornerstone in his portfolio. Then, almost overnight, Eli Lilly struck the jackpot, and in turn, so did my father's holdings. Yet, for over 4 decades, this wasn't a market-beating titan. For a significant stretch, countless other avenues offered far more dynamic returns. Thus, the remarkable success of my father's long-term investing strategy largely hinges on this singular, extraordinary stock. As a man who rarely sells, preferring to hold his investments indefinitely, Eli Lilly became the undisputed architect of his portfolio's current valuation. However, it is paramount to remember that Eli Lilly is a rare anomaly, a true unicorn. Most companies, after 4 decades, do not suddenly reinvent themselves with a miraculous drug that seizes command of one of the most lucrative and expansive total addressable markets, like those for obesity and diabetes. The typical trajectory sees corporations mature into slow-growth phases, and many are fortunate just to remain relevant after 40 years in operation. Consider, for instance, the infamous Nifty 50, an informal, yet highly influential, collection of 50 widely lauded, large-cap U.S. growth stocks that soared to dizzying valuations around late 1972. Among these once dominant giants were names now synonymous with obsolescence: Xerox, Sears, Roebuck and Company, Polaroid, and Eastman Kodak. The cautionary tale here is clear: simply accumulating blue-chip, large-cap stocks and holding them forever is far from a foolproof strategy. History is littered with examples of companies that stumble, fade into obscurity, or even collapse entirely, meeting a slow, agonizing demise in the unforgiving financial markets. Furthermore, we needn't journey back to the 1970s and the Nifty 50 to uncover tales of corporate downfall. Recall the spectacular implosions of Enron and WorldCom, the slow, agonizing decline of Blockbuster and BlackBerry, or the unprecedented government bailouts that rescued financial titans like AIG and Citigroup, often at the expense of existing equity holders. The roster of companies that once gleamed as rising stars only to plummet into obscurity, becoming cellar dwellers barely clinging to existence at rock-bottom prices, is disturbingly long. The undeniable takeaway is this: successfully navigating long-term investing has become exponentially more challenging. In an era teeming with speculative bubbles and a relentlessly accelerating technological landscape, it's a stark reality that perhaps half of the companies flourishing today will likely cease to exist within the next 4 decades. Therefore, resist the dangerous illusion that long-term investing is a sanctuary devoid of risk. While it undoubtedly brought immense rewards to my father, a testament to both his astute judgment and a dash of good fortune, it harbors its own complex tapestry of inherent dangers that many investors regrettably overlook. Every single investment strategy, without exception, possesses Achilles' heels. Your paramount responsibility is to meticulously identify these vulnerabilities and proactively implement measures to mitigate them. Whether your chosen path is the frenetic pace of trading or the patient discipline of long-term investing, the journey will be anything but facile. If it were easy, every market participant would effortlessly amass wealth. The harsh, undeniable truth is that financial markets are notoriously unpredictable, often choosing to crash precisely when complacency is at its zenith, leaving in their wake a trail of shattered financial dreams and aspirations for wealth creation.